A very good day to Doctor and my friends. We are from Group 3 and we are going to present about Audit of Cash. Audit of Cash, which is also known as cash auditing, is a significant process in auditing the financial statement of a company. The cash auditing not only comprises cash in hand and petty cash balance, but also account balance or bank balance. Audit of cash requires auditor to fully or partially assess the cash transaction carried out by the company from an identified start date until the end date. In addition, cash auditing also helps to verify other accounts of assets, liabilities, revenues, and expenses, as most of the business transactions will end up settled through the cash account. Besides, the auditor should clearly understand the possible audit risk in cash and bank balance before implementing auditing procedure on the cash of entity. Generally, cash is a physical form of money that people pay to exchange with goods or services. However, in audit of cash, cash balance refers to cash in hand, petty cash, and bank balance, while cash at bank refers to cash that are held in current or saving account. Cash might also exist as liability if the entity gets the overdraft from the bank or any other institution that it owns an account. Furthermore, cash is a type of inherent risky asset due to its prone to misappropriation and theft. It is said so because of the nature of cash, such as large in volume, high in liquidity, debt convenient, automation of transaction, and high susceptibility of manipulation. With this, auditor will always have to give attention to the cash account when performing cash auditing.
And now we will proceed to audit and control objective for cash. But before I start, we must know that the audit objective is to form an independent opinion on financial statement of the entity. So same goes to cash audit. It is significant in verifying cash account balance. So the balance must be recorded properly and accurately to avoid any misstatement. This is to further ensure that the financial statement reported are true and fair and in compliance with general audit objective as a whole. So basically, the audit objective for cash are categorized into three, which are transaction, balance, and also the presentation and disclosure objective. First, we go to transaction objective. This objective is to ensure that the record on cash transaction is true and fair, and any cash event must be recorded with accurate amount and on the relevant accounting period. To achieve, there are 5 underlying objectives that must be met, which are occurrence, completeness, accuracy, cutoff, and classification. In short, occurrence means that the cash transaction must be proved to be truly take place. Completeness shows that the cash transaction must be recorded. Accuracy strengthens on the accurately recorded cash transaction. Cutoff signifies the need of recording cash transaction in the proper accounting period, while classification raises the importance of recording cash transaction in proper and correct account. Then, we move to balance-related objective. Generally, this objective is to provide a true view on the balance recorded and ensure the figure reported could reflect the financial ability of an entity at the end of accounting period. Here, there are 4 underlying objectives, which are existence, rights and obligation, completeness, and also valuation and allocation. In detail, existence means the cash balance recorded must be truly exist. This balance objective is very closely related to the occurrence as mentioned in the transaction objective just now, which means that the cash event must be truly take place. Then, rights and obligation means entity must have legal title to all cash balance. Completeness enhances that there must be no omission of cash transaction that will give impact on cash balance. Valuation and allocation means that the cash balance reported must be realizable. Finally, presentation and disclosure objective. The 4 underlying objectives are occurrence and rights and obligation, completeness, classification and understandability, and also accuracy and valuation. Basically, the main points here are to properly and accurately identify, classify, present, and also disclose the cash balance. Since cash is of high risk of theft, so there are several cash control procedures that could be carried out. First, recording of receipts by post. Entity can appoint supervisor to supervise the receipt by post and release a more received through mail whenever it is possible. For sure, there must be prevent any interception of mail between receipt and opening. Then recording of cash sales and collections. One of the examples is that only authorized authority is able to receive cash and serially numbered receipt forms must be issued to them as an evidence. While for the general control over cash recording, entity must ensure that the blank pin number receipts book are well safeguarded to avoid any intended party to fill in the blank sheet, as this would result in unfair accounting figure in the statement. To avoid, entity can also have a prompt update of their cash book and ledger accounts. Next, banking. As cash transaction made over the bank is normally in large amount and entity may have large transaction volumes, they must be cautious to avoid any unfavorable situation. For example, they must deposit in bank daily and there must be segregation of duties made between people who collect and people who deposit the cash. To further safeguard cash and bank accounts, they must also have authorization obtained from senior officer and segregation duties must be made between cash flows and bank reconciliation. In short, any cash payment for checks issued must be well controlled. Then, check payments. Here, all payments must be authorized, paid to correct payees, and accurately recorded. For example, check requisition must be supported by related documents and shall obtain authorization from senior officers. Besides, the person in charge for authority, custody, and recording check payments must be a different person. Lastly, cash payments. Any cash advancement and disbursement shall have a limit and cash payments must be made authorized by senior officer. After all, test of control can be carried out to examine the effectiveness of the cash control procedure carried out by the entity. For example, is the segregation of duties, obtaining authorization from senior officers, and any other audit control procedure could really safeguard the cash of the entity? And if it does, to what extent it provides security to the cash available? This test of control is said to have significant effects when an entity intends to rely on the controls. Thank you.
I will now continue on the development of an audit plan for the audit of cash. Before an auditor can develop an audit plan for the audit of cash, firstly, auditors can first understand the client's business and its environment. This is because by doing so, auditors can understand the business risk management policies and control processes to deal with the risk of material misstatement in cash. They should understand the procedures that maintain accountability over cash, which is usually the preparation of bank reconciliation statement and the use of impressed accounts. By understanding the client's business and its environment, auditors can identify the risk of material misstatement in cash balances by identifying the inherent risk and control risk associated with cash. After identifying and assessing the risk, auditors shall set materiality in planning and performing an audit of cash. Then, auditors can determine the audit strategy for the audit of cash. At this stage, auditors shall consider the materiality and risk associated with cash so that the audit strategy can provide scope, timing, and direction of the audit of cash. Lastly, auditors should also refer to the audit strategy and develop an audit plan for the audit of cash. Based on paragraph 9 of ISA 300 Planning and Audit of Financial Statements, the audit plan shall include the information regarding the planned risk assessment procedures and plan further audit procedures to cope with the risk identified through the risk assessment procedures performed. After audit plan has been developed, auditors can then perform procedures to collect audit evidence for the audit of cash. As mentioned earlier, auditors need to understand clients' control procedures in order for them to develop an audit plan, and one of the controls for cash is the preparation of bank reconciliation statement. Bank reconciliation is a process of explaining the differences between the bank balance shown in the bank statement issued by the bank and the bank balance shown in the accounting records of an entity. Bank balance shown in the bank statement and shown in the accounting records are usually not the same on a specified date. This is mainly due to time lags that prevent both parties from recording the transaction in the same period and due to errors by either party when they are recording the transaction. In the audit of cash, auditors shall verify the bank reconciliation statement at the end of the reporting period to make sure that all items reconciling the differences between the bank balance are accurate and valid. This is an important substantive procedure as the verification of the bank reconciliation statement is capable of identifying possible misstatements of bank balances either due to fraud or due to error. One of the most common items in the bank reconciliation statement is the unrepresented checks. Unrepresented checks, also known as outstanding checks, are checks that are issued by the entity for disbursements but have yet to be cleared by the bank or have yet to be presented to the bank for clearance. In the presence of an unrepresented check, there is a difference in the bank balances as the disbursements were recorded in the accounting records but have yet to be deducted from the bank account. In the audit plan, to verify the bank reconciliation statement, auditors can select unrepresented checks from the bank reconciliation and trace to the subsequent bank statement to make sure that they are cleared before year end. They can also select from bank statements that are dated just after the year end the check payments dated before year end by referring to the check stubs and trace them to the bank reconciliation to make sure they are listed as unrepresented checks in it. Another item that is commonly included in the bank reconciliation statement is the uncredited deposits. Uncredited deposits, also known as deposits in transit, are deposits made by an entity into its bank account but have yet to be credited by the bank into the entity's bank account. In this case, cash receipts were recorded in the accounting record but have yet to be recorded by the bank. Or in other words, deposit might have yet to appear in the bank account. To verify this, auditors can select uncredited deposits from the bank reconciliation and trace them to the subsequent bank statement to make sure that they are deposited into the entity's bank account right after the year end. They can also select deposits which are deposited before year end from the bank statement dated just after year end by referring to the deposit slips and trace them to the bank reconciliation to make sure that they are listed as uncredited deposits. Another common control procedures for the control of cash is the imprest accounts. Imprest accounts, also known as imprest petty cash system or just petty cash system, is a system of maintaining, keeping, and reserving a fixed amount of cash on hand in a petty cash box for the disbursements of small amounts using physical cash rather than just using checks. The fixed amount of cash is also known as the imprest level. When entity uses imprest accounts, every disbursement made using the fund in the petty cash system is supported by an appropriate document. For example, payment voucher, supplier's invoice, special petty cash voucher that is authorized by a responsible official. When funds are low or after a specified period of time, usually monthly, personnel who are responsible for the petty cash system will request for reimbursement back to the imprest level by providing the supporting documents. An entity that practices an imprest petty cash system usually has certain internal control procedures to manage the fund. Auditors shall understand the control processes first in order to help them identify related risks which would be useful when developing an audit plan. For example, some of the most common internal control procedures practiced are always ensure that the cash in the petty cash box plus the fund used for disbursement is always equal to the predetermined imprest level. Next, this fund is also usually in the custody of a trusted employee and not to be managed by lots of employees to prevent theft of cash. Furthermore, the petty cash box shall be kept in a secured place, for example, in a safe. And funds for the petty cash system shall be kept separately and not mingled with other cash in hand. Besides, each disbursement made shall be supported by appropriate documentation and the amount shall be only allowed for small amounts. During reimbursement, the responsible official shall review the disbursements based on the supporting document. Supporting documents that have been used shall be stamped with paid to prevent the reuse of the supporting document. Next, I will move into the materiality and risk when developing an audit plan for the audit of cash. In most of the cases, cash itself has higher materiality relative to its balance as compared to other accounts balances, despite that cash balances usually is only a small proportion of total assets owned by an entity. This is because cash is the element that reflects the solvency of an entity, which subsequently determines the survival of the entity as a going concern. For example, an entity that may be profitable over the years may cease to be a going concern if the entity experiences insolvency, whereby it is not able to pay off its outstanding debt due to a shortage of cash. In addition to that, most business transactions, regardless of which transaction cycles that they belong to, usually affect the cash account. Therefore, due to this nature of cash, the cash balance is always qualitatively material despite that it may be quantitatively immaterial for some entities that hold only a little cash balance as compared to the total assets owned by the entity. Therefore, during the development of an audit plan, auditors shall be aware that the cash balance has high inherent risk due to the high volume of transactions for assertions, particularly existence and completeness. Another factor that causes cash balances to have high inherent risk is that cash itself is susceptible to theft. Therefore, during the determination of the audit strategy that guides the development of the audit plan, auditors shall consider the materiality and risk associated with cash to make sure that the tasks to be performed are effective.
I will present about audit strategy for audit of cash. Firstly, we have to know what is audit strategy. Audit strategy can be defined as an overall approach which should be performed by an auditor when conduct the audit work. For example, when an auditor engages with a new client, they will set an audit strategy on whether which approach should be used, such as the test of control or the substantive test. So audit strategy will also set the direction, timing, and also the scope of an audit. And we have to know that audit strategy is the basis of audit plan. Now, we will move to the objective of audit strategy. Audit strategy is aimed to minimize the audit risk. Besides, it is also aims to allocate and manage the resource efficiently, and lastly, to perform the audit work in an efficient and effective manner. For the scope of audit of cash, audit strategy depends significantly on the substantive test. This is because most of the cash transactions has been tested in other cycles, such as the payroll cycle and also the revenue cycle. So the audit approach will focus on verifying the account balance. Its key procedure is to audit the bank reconciliation and reconcile it with the bank confirmations. So any difference found during the process should be considered as material, as the auditor should be able to verify the account accurately. Then the auditor should also always alert with the possibility of frauds when they audit the cash, as the cash is liquid and it has a high inherent risk. And there is some frauds related to cash, which are commonly known as the kiting and also lapping. These frauds will falsely report the actual cash position in a client company. Now, we'll discuss about kiting. Kiting is a fraudulent activity which uses the financial instrument to obtain unauthorized additional credits. So, kiter will take advantage of the float time, which is the time required by a check to withdraw from that account to deposit into another account. Check kiting occurs when there is a check was drawn in a bank and deposited in another bank, but there is no record of the disbursement of the first bank balance. So, for example, there are two banks, which are Bank A and also Bank B in a company with insufficient funds. With the aid of float time, a kiter will deposit a check from Bank A to Bank B. Before the check is in Bank A is clear, the kiter will withdraw the money from Bank B and deposit it back to Bank A. So this is how kiting works. And there are some signals related to kiting which can be spotted. Firstly, the signature and payee on the kite checks are usually the same. This is an indicator that there might involve a single perpetrator in the case. And secondly, there is an area of abnormalities, which is about the use of bank in different cities or regions to make transactions. This is because the kiters will want to gain more floating time, so they will use this approach to gain the time. And thirdly, kiter will make frequent deposits, and they will write numerous checks. This is a method that kiter will use to conceal themselves. And fourthly, bank authorities should always alert with the customer who makes frequent inquiries about the balance. This is a way kiter use to understand the floating times and to determine their bank balance. Besides, the signal of escalating balance. This is because the check made on each time should be great enough to cover the previous checks. And the next signal is about the bank abnormalities. This signal is that a kiter will usually deposit the check drawn in the same bank. This is abnormal for a business to always deposit check from the same few banks. And lastly, is about the signal of short average time length for the money to remain in an account. There might be a kiters make use of the float time to make kites. So, how an auditor can detect the existence of kiting? An auditor can use and observe the bank transfer schedule to detect kiting. This is because bank transfer schedule will record the details of transfer activity or the transfer dates between the entity account. It also shows the clearing dates in the bank and also the entity's book. So any inconsistency that an auditor finds on the disbursement dates and also the receipt dates will clearly show that there's a fraud of kiting. For example, if the date of the receipt by Bank B from Bank A is earlier than the disbursement date of Bank A, it indicates that's about the occurrence of kiting. Next, we will discuss about lapping. Lapping involves the act of stealing the receipt or cash or credit, and they will not record it to hide their act. Then the unrecorded receipt is then covered by taking the subsequent receipt and apply it to cover the theft. For example, When a cashier steals the money from the first customer will then steal the money from the subsequent customer and make it as the payment of first customer to hide his or her egg. Lapping occurs easily. When there is only one employee is granted all the authorities, custody, and also the recording task of the cash at the same time. And it often happens in a small company. There's a signal of lapping when a bookkeeper who is responsible for the accounting task always refuses to take vacations. So here are some control procedures to prevent lapping. Firstly, is about the segregation of duty. So a company may hire a different people other than the cashiers to deliver the statement to the customer. So the customer can be aware of their payments and they are able to detect any unusual payment attributed to their accounts. So besides, an audit of cash receipt transactions should be carried regularly because the cash is the most easier access to fraud. So it will be easier to detect when it occurs if the audit of cash receipt transaction carried out regularly. And thirdly, the company may also require all their employees who are responsible for the accounting task to take vacation with no exceptions. So it can prevent the employee from covering the lapping scam. Then, a company can also track the days of the account receivable on a trend time and trace the payment to outstanding receivable. Moreover, a company should also control the use of credit memos strictly, as the labor might written off the missing funds in the receivable by using a credit memo to hide the egg. Next, a company can also stamp all the checks with the phrase of for deposit only, so it can help to prevent its employee from deposit the check from customer into their personal accounts. And besides, the company can also require the customer to make a payment in the lockbox. So as a result, the employees cannot steal the money and the cash will not be intercepted. So, furthermore, a company can also make account receivable confirmations on a surprise basis other than make it on certain time. So the bookkeeper has no chance to destroy the evidence. And in addition, the calculation of cash can be made surprisingly. As a result, the lender has not enough time to make the preparation to prevent the fraud to be known by the auditor. And lastly, the control method of comparing the details of cash receipt journal entries with its corresponding deposit slips should assist in revealing the differences. So the kiting can be found. And thank you.
Substantive procedures for cash are an approach that carried out by the auditor in determining material misstatement in transactions and ending balance with supported evidence at the exception level, which relevant to completeness, right and obligations, relations and obligation, and lastly classifications. It involves the test of details of transaction, the test of details of balance, and auditing impressed petty cash funds. So, every time before we proceed to the test of details of transactions, the auditor must examine the amount of all the supported documents given by the clients and ensure there is no difference between the cash in the system with the audited amount during the previous year. Test of transaction is a procedure to track the specific transactions and internal control validity. So, there are two measures in this. The first one is cash cut-off method. This test is to make sure the amount of cash received and paid is recorded correctly during the proper accounting period and to avoid overlapping and misstatement of material. However, it is also useful in determining the outstanding cash receipt and disbursement because it helps to gather the transactions that happen on the client's bank reconciliation within 10 days after the closing date of financial statement with the purpose of proper cut-off. The second is to trace the bank transfers, which is to detect the overstatement or misstatement of cash during the floating period because the company may be having more than one bank. Moving to test of details of balance, it is a procedure to get the information and evidence about the cash balance of the clients. So there are several substantive tests applicable for cash balance value, which include confirming bank balance and other arrangements, verifying bank reconciliations, and counting cash in hand.
In confirming bank balance and other arrangements, the auditor will send the confirmation letter directly to the bank with the purpose to get information such as client bank's balance, outstanding interest, loans balance, and overdrafts. Secondly, verification of bank reconciliation is needed when the level of detection risk is doubtful. The auditors may trace and validate adjusting entries and reconciliation, such as transit deposit, unpresented check, errors, and bank charges, to ensure a proper accounting is done and detect any non-matching transaction. The last one, the substantive procedure for counting cash in hand, is to make sure the money is controlled by the auditor and all negotiable instruments are kept until all funds are counted. Next, the custodian of the cash must be presented on the spot, throw out the count, and make sure the custodian sign on the receipt from the return of funds. And lastly, all the undeposited check being payable to the order of the entity or through endorsement. Moving to auditing impressed petty cash funds. This will only happen when the company requests the petty cash to be audited or it is an uncommon occasion due to the immaterial amount in the bank account of the company, cash account of the company. For conducting the substantive test on petty cash fund, the auditor must understand the procedure of the client in handling the fund, which relate to the test of details of transaction and test of details of balance. Other than that, test of replenished transactions should be applied if needed, because replenishment could lead to defalcations if the custodian did not attach with any supported or irrelevant documents, and they would request false amount of cash or embezzle the money for sale purpose. Hence, auditing on petty cash is very important as well.
Now, I'm going to present about the current issues and uses of information technologies in audit of cash. The outbreak of COVID-19 pandemic has disrupted most of the profession around the world, with accounting and auditing being no exception. Currently, different level of movement control order is implemented by the Malaysian government in different areas according to the number of active cases in that location. As a result, the auditors could not physically travel to the audited entity premises. This is quite challenging for the auditor in obtaining the physical forms of evidence which are sufficient and appropriate for auditing. We have to note that it is important for auditor to prove the existence of physical evidence. To overcome it, the auditors can make use of the information technology, such as having a video call with the audited entity premises to have a look at the physical evidence. Auditors should take screenshots when observing the physical evidence and select more items to be tested than usual to ensure the accuracy and reliability of the evidence shown by the staff of the audited entity premises. World Health Organization suggests people to use digital payment method to fight against the spread of COVID-19. It is because this can prevent the body contact between people. With more people using cashless payment method instead of the traditional cash payment method, auditors need to spend more time to analyze the entity's electronic sales record, other than just focusing on the physical cash collection, cash records, and cash payment that occurs during the financial year. There are 4 specific procedures required for the auditor to perform the auditing of cashless payment. Firstly, the auditor will need to identify all the digital payment methods accepted by the audited entity, such as credit or debit card and digital wallet. Secondly, the auditor would have to evaluate the roles and responsibility of the employees that receive, record, report, and analyze the cashless transactions that occur daily. After that, the auditor will have to test the reconciliation process by review the previous sales reconciliation to examine their accuracy and ensure the revenue recognition is appropriate. Lastly, as a cashless transaction can create an electronic audit trail, auditor has sufficient data to analyze the trend. Cash AI is an artificial intelligence tool that automates the cash auditing. This is a new tool that innovated by PwC with the name Cash AI in the year 2019. It can automatically read, understand, and test the audited entity files or documents which comprise of bank confirmation letters, reported cash balance, bank reconciliation, foreign exchange, as well as the bank's financial condition. It can improve efficiency, audit quality, and stakeholders' satisfaction, as well as enhance the relevance and value of assurance services.
In conclusion, when referring to the audit of cash, the cash here refers to the cash in hand, petty cash, and bank balances that an entity has. It is the auditor's responsibility to understand the specific audit objective for cash, which are derived from the management assertions. Auditors must understand the control procedures practiced by their clients and their control objective. Auditors can perform tests of control to understand the effectiveness of control procedures designed by clients in ensuring that the cash balances are recorded accurately by way of preparing bank reconciliation statements and using an impressed petty cash system. Auditors shall also be aware that the primary audit strategy in the audit of cash is to verify the balances in the cash account, as cash mismanagement may occur in form of kiting and lapping. Auditors should be concerned about the materiality and risk pertaining to cash when determining the audit strategy too. Although cash balances are usually insignificant in quantity, cash itself is a qualitatively material item in the financial statements given its ability to affect an entity's liquidity and going concern. Due to this nature of cash, it has a high inherent risk, and auditors shall assess risk associated with cash by understanding their clients' businesses and its environment. After audit plan has been developed, auditors can perform risk assessment procedures and further audit procedures to collect audit evidence. Examples of such procedures are tests of details of transactions, tests of details of balances, and auditing impressed petty cash funds. Due to the importance of audit of cash in an engagement, issues arise particularly during the outbreak of COVID-19. Auditors have to find ways to audit their clients, although being restricted in terms of their movement due to the MCOs. For example, they have to find ways to audit cashless transactions while they are working from home. Therefore, the role of IT has become more and more vital in the audit of cash, and several organizations have made a milestone in this issue. For example, the development of Cash AI by PwC. In a nutshell, the audit of cash is one of the most important part in an audit engagement, and auditors shall always be competent in the audit of cash. That's all from our group. Thank you.